Good morning and welcome to Charting the Markets on Wednesday, the 18th of October 2023. Earlier today, Asian stock markets were mixed, with the Shanghai index dropping by 0.8% despite a host of Chinese data points that beat expectations, including GDP, which expanded by 4.9% in the third quarter versus an estimated rise of 4.4%. Also, retail sales hit a 4-month high as various Chinese stimulus packages seem to have had a positive effect on consumption. Now, here in the UK, inflation came in higher than expected at 6.7% in September. So we had both the headline and the core figure coming in higher than expected and showing us that inflation remains stickier than hoped. And this brings to an end a run of falling inflation readings and will also complicate the outlook for the Bank of England. So let's begin by having a look at the FTSE 100 index. And you can see here on the daily financial bet that we have managed to rise above the 200-day simple moving average here in red at 7,649 yesterday and closed above it. And that technically is quite promising for the bulls, because it does indicate that the likelihood is that we are going to retest the late July and September highs between 7,723 and 47. And this view will remain valid as long as we stay not just above this accelerated uptrend line here, but also above the last reaction low, that is to say a low which is lower than the one to its left and to its right on the daily candlestick. And this was the low seen on Monday at 7,583. So basically, as long as we stay above there, further upside is likely to be seen with regards to the FTSE 100, which could then take us back to these highs over the next few days. Now, in Germany, the situation is not looking as positive, because what we've seen here with regards to the DAX 40 is that, yes, we did come off our early October low at 14,944 on this daily financial bet, and then rose into this key resistance area made up of the July to mid-September lows between 15,455 and 15,561. Now, this resistance area on Thursday last week capped the market, and since then we had a very sharp sell-off, take us back to Friday's low at 15,108, and then Monday we also retested the low and dipped slightly lower to 15,104 before just consolidating in a very low volatility range trading environment. So at the moment we are not really coming off, despite the heightened tensions in the Middle East, but we are not really rising either, and that despite earnings so far in the US basically coming in much better than expected for quite a lot of companies and some major banks. So we'll have to see what the DAX 40 will do going forward. Basically, for me, provided we stay above the early October low at 14,944, the odds are still pointing towards higher prices to be seen over the coming weeks and months into the year end for seasonality reasons. But for this bullish view to gain traction, what we need to see is first and foremost a rise above Thursday's high at 15,575 on a daily chart closing basis. And ideally, what I would also like to see is a rise and daily chart close above the July to October downtrend line. And this can currently be seen around 15,622, just below the red line here, the 200-day simple moving average at 15,671. So short term, not much going on here. Provided we stay above the current October low, further upside may happen going forward. If we were to fall through it, the technical picture would really become far more negative. And in the US, very much will depend on earnings. And we've got earnings out later on today by the likes of Netflix and Tesla, which will take center stage this evening. And that could have an impact on today's and tomorrow's session with regards to US markets. And here the S&P 500, we can see, is currently range trading within its key resistance area made up of the late June to basically mid-August lows, and also now the current October high between 4,328 and 4,398. And we're just range trading within that resistance area. Now here from a technical perspective, provided we stay above the last reaction low, as I said, that is a low on the daily candlestick, which is below the one to its left and to its right. That was made on Friday of last week at 4,311. Provided we stay above there, the odds are still pointing towards for the upside to be seen. And if we were to rise above 4,398 and close above that level, we could then head not just up to the 24th of August high at 4,474, but also try and reach before year end the September highs between 4,516 and 14. Now, with regards to the US dollar, the US currency has once again been used as a flight to safety currency and did so on these heightened tensions in the Middle East and the expected ground invasion of northern Gaza by the Israeli Defense Force. And if we look at the euro against the US dollar, we can see here that the euro on those heightened tensions fell again at the beginning, actually at the end of last week, and did hold though above our key support area, which goes back to the December and January lows that we saw between 104.84 and 44. And as we know, the low made so far in October was right within this support area, which keeps on holding for the time being. So here we've bounced off it on Friday last week, and we are grinding higher. So the US dollar is, despite these flight to safety flows into the US dollar, not really gaining traction against the euro, at least in the short term. But what is interesting from a technical perspective now is that we are testing for the fourth time this downtrend channel resistance line. Now, a break above here today on a daily chart closing basis could indicate that we could actually retest the current October high at 106.39, and a break above there would technically form a bullish reversal pattern and could take us back up towards the high seen at the end of September at 107.36, and also perhaps the 200-day simple moving average here in red at 108.23. So this is a possibility, provided that key support area going back down to 104.44 continues to hold on a daily chart closing basis. And if you look at cable, the British pound against the US dollar, basically the situation is quite similar in that we dropped to 120.38 at the beginning of October. That was a level last traded in March of this year, and we have held above the psychological 120 mark so far, even though we did dip down back towards it on that strengthening dollar at the end of last week and fell down to 121.23, above which we've been range trading since then. So not much going on here. You can see the candles are really small, so a little volatility being seen. But here, provided we stay above 120.38, I would expect another attempt at breaking through the July to October downtrend line at around 123.14 to be seen. And then what we need to see for the bulls to be back in control is a rise in daily chart close above the last reaction high. That is to say, a high above the candles to its left and to its right. That is to say, above last Wednesday's high at 123.37. Once we see that, we could then head back up again towards the red line here, the 200-day simple moving average at 124.45, and possibly also towards the late June and mid-August lows between 125.91 and 126.17. Now, the last currency pair I'd like to look at is the Australian dollar versus the US dollar. And again, it looks quite similar. So we can really see here the theme is the US dollar. Here, over the last 3 days, we've seen some gains versus the US dollar, and we have managed to earlier, or actually at the end of last week, to hold basically at that 62.86 low that we've seen earlier in the months as well. And we are now trying to break through the July to October downtrend line. And again, as was the case with cable, as was the case with the euro versus the US dollar, we need to rise above last Wednesday's high, in this case at 64.45, for us to form a double bottom. And in that case, the target of the double bottom would be the distance from the, if you look at this W formation, from this middle point here at 64.45, and you take that distance down to the low at 62.86, and then project it higher from the breakout point at 64.45, and that would take us probably above the September highs between 6 from its early October low at $83.12, and now we've actually risen for the first time since June above the June to October breached uptrend line, which beforehand acted as a resistance line because of inverse polarity on Friday and also on Monday of this week, but now we're breaking above there. So once that happens, you can actually remove your trend line, and basically what it means is that we're heading back up again towards the September highs between $94.97 and $95.33. So further upside looks to be in store for the price of oil. Now, this might not have a good effect on inflation in general and could lead to investors thinking that the Fed will have to keep rates higher for longer. So from a technical perspective here with regards to the oil price, we need to stay above the last reaction low, that's to say the low seen on Tuesday. A reaction low is simply a low which is low on the daily candle below the one to its left and to its right, and that was made on Tuesday yesterday at $88.05, and that's also where the orange line more or less comes in here, the 55-day simple moving average at $88.22. So basically, provided we stay above $88.05, further upside looks to be in store for the oil price as well. And gold has been a similar safe haven commodity. As we can see here, the price of gold has surged higher over the last few weeks, and now we are actually trading above the red line, the 200-day simple moving average at $1,930 per troy ounce, and are heading and basically practically have already reached the late September high at $1,947, above which we can see the September high at $1,953, which is also an upside target for us today with regards to the oil price, as investors go into oil, invest in oil as a safe haven commodity. Now, if we were to rise and close above $1,953, the early September high, the next upside target would be the July high at $1,987. That is the next upside target ahead of the psychological $2,000 mark. But you can see here, very strong upside to be seen with regards to the price of gold. And if we look at silver, the situation is quite similar in that we have now broken through the August to October downtrend line, managed to close just on it yesterday, but today it looks pretty likely that we're actually going to close above it, which is technically significant. And we are also approaching the 200-day simple moving average here in red at $23.33, which is also key, because once we rise above that, we should be heading back up again to the late September high at $23.77. Once that has happened, if that were to be overcome, which looks pretty likely by the look of things at the moment, then we could be heading back up again towards the July and August highs at $25.01 and $25.26. So really strong upside momentum being seen here in the silver price as well. And that short-term upside momentum will remain intact provided we stay above yesterday's low, the last reaction low, that is to say at $22.37. Now, I'd like to finish up on today with a look at New York number 11 sugar. And if you look at these futures contracts here, we can see that the price of sugar is heading back up again as sugar producing countries are facing a drought, and thereby the supply of sugar becoming tighter and prices increasing. And what we're seeing here is a rise taking us back up towards the September high at 27.85 on the front month futures contract. That was a 12-year high. So it'll be interesting to see whether we can reach that 12-year high again. And if we were to overcome it, we could then head up towards the psychological 30 mark with regards to this futures contract. And this view will remain valid provided we stay above the last reaction low, that's to say the low from last Thursday at 26.12. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X, formerly known as Twitter, and my handle is @AxelR_IG.